Hi, I'm James Robinson, and this is my stock pick of the week. Today we're going to talk about the balance sheet for Oil-Dri. And balance sheet is really a look at the company's financial risk. It's how strong is the company, what's the company doing with its money in terms of its cash, its marketable securities, and also its debt. And it looks at that. This is not the kind of thing that makes you necessarily want to buy a company, but it's the kind of thing that can very, very often make you not want to buy a company. There's a lot of companies out there whose balance sheets are just horrible. And the problem with that is when you've got a ton of debt, when things go wrong and there's an international pandemic, for example, or a recession, it's the thing that can tank your company and or make it your ability either able to sustain itself through those bad times or to crush your company through the good times. So I look at balance sheet as sort of a red light more than a green light, but I think it's the kind of thing we should talk about. I also think it's the kind of thing not many people invest a lot of time in. The first thing that I look at is cash and marketable securities. So that's really how much money you have on hand to handle your business, right? And to some extent, the more of that you have, the better, because it means you're better and better able to sustain your operations through the bad times. The problem with that is that you don't want unlimited resources in cash and marketable securities, because at some point that's money that you could and should be returned to the shareholders in several different forms, whether that's dividends or buying back shares or investing in operations, paying down debt, for example. So what I like to see is cash and market securities at a respectable level. I like to see that it's consistent, and I like to see that the company is keeping the right amount of money for their operations. I don't know what that is exactly. That's a moving target maybe. But what I really like about this company is that the cash and marketable securities has been relatively flat for 20 years. And during that time, the company's earnings have gone from virtually nothing to $18 million a year. That tells me that this company is very efficient with their way they're using their cash and market securities, and that's very exciting to me. So here we see current assets and current liabilities. And again, for those of you who aren't accounting nerds, current assets, that's money that they either have or will have in the next 12 months. And current liabilities is money they either have or will owe in the next 12 months. So a receivable is an asset, even though it's not cash, right? And receivable is one of the things that's included here. So what I like to see is a safe margin between these two. I like to have enough current assets to more than offset the current liabilities. Now, the interesting thing about this is, again, that the current assets are gradually growing, but really the current liabilities are growing very, very slowly. That's a great sign that this company is doing a great job of managing its growth. When you think about the fact that since 2004, this company has tripled its income, and yet the current liabilities have gone from, about 28 million to, maybe 32 million. You see that, wow, this company is doing a great job in terms of managing their operations in such a way that their costs aren't getting out of control. And that's a really, really good sign. So interest payments, this is the manifestation of debt. So if you think about it, nobody really cares what your debt level is. That's money that you at some point have to pay back to the bank, but it's not going to kill you. In theory, sooner or later, you're going to pay it off. Or you're just going to hold it on the books forever and continue to grow operations, and it becomes less and less important. But the manifestation of having that debt is that you do have to pay interest on it. And those interest payments are what can kill you in the bad times. The fact is, when times are rough and you stop making a profit for whatever reason for some short period of time, if you don't make a profit and you don't have enough reserves and you have these interest payments eating away at you every day, it's the kind of thing that drives you into bankruptcy. It's the kind of thing that can destroy your business. It's the only real cost that can't be scaled up or down. For example, if the demand for your product were to temporarily reduce, you could reduce production, you could reduce costs and weather that storm. But interest payments, you can't do that with. The only way to reduce interest payments is to write a big check to the bank. And if you're having a reduction in, the economy's hurt your business, the last thing you want to do is hemorrhage money to the bank. So we look at interest payments through that filter of, it's the obvious risk to the company's survival in the bad times. You can see here the company was debt-free until 2007. They took on some money, no problem. I don't care that they did that. It's a very stable operation. And then you see that they gradually worked that balance down. And since 2013, the interest payments have gone down every year. And that's interest payments in general and interest payments related to operating expenses. So it's really, really good. One thing to note is that the company has just taken out another $18 million in debt. And the result of that is I would expect interest payments next year to go up because they're going to have to pay debt service on that money. It's not relevant. It's not significant. It's not going to hurt our performance at all. But it is something to note. This sort of dovetails with what I was just talking about. You can see in red the company's debt, which had been paid off basically every year since 2011. They just borrowed a little bit of money in 2020. But I don't think it's enough that's going to matter, but it is going to make the interest payments going up. The other thing to look at is the company's total current liabilities. That's gone along pretty flat, no problem at all, especially when you think about how much revenues have increased and how much income has increased over that period of time. The current liabilities obviously have gone up because they borrowed some money. But again, I'm not really worried about this little jump for the last year. It really is a non-issue. It's just something to call your attention to because I was aware of it, so you should be aware of it. Interest coverage ratio is simply the amount of money that you're making in profits related to the amount of money you owe in interest. And I've got down here a minimum interest coverage ratio of 1.5, which means you have to make at least 1.5 times what you are paying in interest. Probably that number, if anything, is too low. I'm not sure I would ever buy a company that actually was 1.5 or less. But that's kind of where I put the minimum level. And you can see this company is, consistently above 8 times up until about 2014. And then since then it's skyrocketed. Remember, since 2014, they've been paying off their debt. So their interest obligations have been reducing while their earnings have gone up. So this number is skyrocketed. They're currently, as of 2019, they were 23 times. They had 23 times the earnings that they needed to pay the interest obligation. That number will drop a little bit because they just borrowed some money, but again, it's inconsequential. This company is extremely, extremely solid in interest coverage ratio, and again, it just speaks to the financial solvency of the company. Another measure that I use in terms of looking at debt is how long would it take you to pay off the debt, and what I like about this. What this really is how many years of income would it take you to pay off debt if you used 100% of the income for nothing but debt service? And the reason that I like this is because interest is relevant. I mean, Apple has, tens or hundreds of billions of dollars in debt, but they have so much money in cash and they have so much money in earnings that that level of debt is serviceable without any problem to the company. Other companies are much, much smaller and their earnings are much, much smaller, even though their debt is much smaller. So this is something that normalizes it for me. It allows me to say, hey, where does this company rate relative to my level of risk? I like to see a company be able to pay off its debt with 3 or 4 years of income. This company can pay off all of their debt with 1 year's income, which is fantastic. So this company's debt relative to its income is in no way worse. I mean, it's actually, one could argue they should borrow more money because interest rates are so low. So this is a great company. The debt is in no way a problem for the company. So I want to talk about 3 other things that don't have to do exactly with the stock. The first one is that if you want real-time information when I buy and sell stocks, the way to get that information is to follow me on Twitter. My handle is @RobinsonStocks. Oftentimes it takes me time to get around to making these videos. Unfortunately, I have a day job. I've got 8-year-old twins, and they take a lot of time, and that just doesn't give me the bandwidth to make videos every day like I'd like, or certainly make videos the day I make trades. For example, I recently sold our position in Raytheon that we'd owned for a very short period of time, but we made about 27%. And so if you'd like to know what I'm doing when I do it, the best place to do that is on Twitter. And again, my handle is @RobinsonStocks. You'll see those updates. You also will find news and thoughts on the market occasionally when I see something that's interesting. Secondly, I keep this map of where my followers are. It's really the only reward that I get for doing this, which is that, it just makes me feel good to, when somebody from Moscow starts following me, which happened to me last week, or somebody from, Sao Paulo or wherever. So if you enjoy these videos, then I would appreciate it if you would obviously everybody likes that, or subscribe. But just drop me a note in the comments that says, hey, I'm from, fill in the blank. I'm from Venice, Italy. I'd love to know where you're from. And I'd love to add your dot to the map. Finally, I've decided that I have a goal. I want to get to 1,000 subscribers. That goal is in part because it's a nice round number. In part, some of you may not know this, but when you reach 1,000 subscribers, then YouTube will start paying you for your videos. I think it'd be pretty cool to get paid for these, obviously. So I'm at 259 subscribers today, and I'm going to update this chart over time, and hopefully you can help me get to 1,000 subscribers. I'd appreciate it. So that's it for the operations of the company. I really appreciate it, and thanks for your time.